Welcome back to the deep dive. Today is Wednesday, January 28th, 2026.
And if you've had an eye on the markets this morning, you know why we're here.
You absolutely do. We are jumping straight into the earnings report that dropped last night. It's the big one, Tesla Inc., ticker symbol TSLA, for the fourth quarter of 2025.
And, I say this every quarter, but this one feels different. The sheer amount of data, the shift in tone, it feels heavier.
Heavier is a good word. Definitive, maybe. I mean, for years we've had this debate, right? Is it a car company? Is it a tech company? But after reading this report, I honestly don't think you can call them just a car company anymore.
No, absolutely not. And they're making sure you know that. The language is explicit. They're officially calling themselves a physical AI company now.
And it's not just marketing speak. You look at the numbers we have in front of us, the actual financials, the spending, the way the margins are shifting. You can see the transition happening in real time.
It's undeniable. And it's messy. It's expensive. But it's happening.
Messy is the perfect word. I mean, on one hand, you have automotive volumes contracting, which is a big deal we need to unpack.
Huge deal.
But then you have energy deployment that's just surging. And then you have this AI spending that is, frankly, eye-watering. There's so much tension in these numbers.
It's a complete tug of war. You've got the legacy business, selling cars, and it's hitting a cyclical wall, high interest rates, competition, all of that.
Right.
And then you have this new business, the AI, the robotics, the energy grid, and it is just a voracious beast, demanding every single spare dollar of cash the company can generate.
So that's our mission for today's deep dive. We've got the institutional grade analysis, we've got the press release, all the internal metrics. We're going to try and look past the headline volatility because the stock is moving all over the place this morning.
As it always does.
And we're going to try and find the signal. Is this a company in trouble? Or is this a company shedding its skin to become something much, much bigger?
And a little spoiler alert here, the verdict on the quarter is technically a beat. But it is one of the most complicated beats I think I've ever seen.
Yeah.
This is not the kind of beat where you just, pop the champagne and take the rest of the day off.
No, this is a read the fine print kind of beat. So let's get into the machinery of it.
Let's do it.
Slide 1, the at-a-glance scorecard. Okay, so let's start at the very top. The headline revenue number. Total revenue for Q4 came in at $24.901 billion.
So call it 25 billion. Which is just, it's an enormous amount of money. I think we get a little desensitized to these numbers sometimes. A company generating 25 billion in just 3 months is, well, it's the GDP of a small country.
It really is. And here's the headline that's driving the stock today. It beat Wall Street consensus. The street was looking for something around $24.5 billion.
Right. So they cleared that bar by about $400 million. And that's your beat. That's the green arrow you're seeing on your screen this morning.
But, and this is the big but, and we have to be the adults in the room here, we need to talk about where that bar was set.
Exactly. You have to ask, how low was the bar? And it was low. The sentiment going into this report was incredibly negative.
So this feels much more like a relief rally than a genuine growth rally.
That's a perfect way to put it. Because if I look over at the year-over-year column on our scorecard, revenue is actually down.
Correct. Down. If you just zoom out 12 months to the fourth quarter of 2024, their revenue was $25.7 billion.
So let's be clear. Despite beating the estimates for this quarter, the company has actually contracted by 3.1%.
And that is such a weird feeling for a stock that's still priced like a hyper-growth company, isn't it? The market is cheering a beat when the business is actually shrinking.
It really speaks to the expectations game on Wall Street. The analysts had priced in an absolute disaster. They saw the high interest rates, they saw the competition from BYD in China, the legacy automakers finally getting their act together in Europe.
They were expecting a bloodbath.
A total bloodbath. They lowered the bar to the floor, and what they got was, well, a mild flesh wound. And in that context, a mild flesh wound feels like a victory.
So let's dig into that 3.1% decline. Why is revenue down? It's not a crash, but it's definitely not the 50% growth we got used to seeing a few years ago.
Well, it comes down to the two fundamental levers of any business, right? Volume and price.
How many you sell and for how much?
Exactly. And both are under pressure.
Yeah.
On the volume side, they're simply delivering fewer cars than their peak growth trajectory would have suggested.
Yeah.
The market is just, it's tougher.
And we're still sitting in a pretty high interest rate environment here in early 2026. A car loan is expensive.
It's very expensive.
Yeah.
The consumer is feeling stretched, they're tapped out, and their options for an EV are better than they've ever been.
That's the saturation point. You look at China, BYD is relentless. You look at Europe, the legacy guys have finally put out some decent EV platforms.
The competitive mode isn't what it was in 2021. So to keep the factories running and keep the metal moving, Tesla's had to pull that pricing lever. They've cut prices, and that hits the top line directly.
So revenue is better than feared. That seems to be the takeaway. But let's move down the income statement to the bottom line, because this was the number that when I first opened the PDF last night, it actually made me gasp.
The profitability drop.
Yeah.
This is where that whole physical AI pivot stops being a cool marketing slogan and starts being a very real, very expensive line item on the bank statement.
Okay, so the number, GAAP net income, it came in at $840 million.
Which in isolation is fine. Making almost $1 billion in profit in a quarter is not a failure.
No, but you have to compare it. Compare that to last year.
A year ago, Q4 2024, that same number was $2.128 billion.
So that's a 60.5% decline.
It's a precipitous drop. There's no other way to describe it.
They wiped out more than half of their profit in just 12 months.
They did. And if you look at it on a per-share basis, the GAAP earnings per share, it's the exact same story, 24 cents per share, which is down 60% from the 60 cents they posted a year ago.
But wait a second, this is what's confusing me. I saw headlines all morning saying they crushed earnings expectations. How do you crush earnings when your profit falls off a cliff by 60%?
And that, my friend, is where we welcome you to the wonderful world of non-GAAP adjustments.
Ah, the adjusted numbers.
The headlines are all focused on the adjusted EPS, the non-GAAP number, and that came in at 50 cents.
Okay, 50 cents. And the expectation was what?
The consensus on the street was for 44 cents. So 50 cents is a solid beat against 44, and that's the narrative that stabilized the stock after hours. That's the better than feared story.
But I want to go back to that GAAP number for a second.
Yeah.
That 60% drop. If revenue only fell by 3%, how on earth did profit fall by 60%? The math just feels so incredibly disproportionate.
It does. And this is probably the single most critical concept for you, the listener, to understand about this entire report. What we're seeing here is a textbook case of something called negative operating leverage.
Okay, break that down for us. Negative operating leverage.
So normally in a healthy, growing company, you want the opposite. You want positive operating leverage. That means, if your revenue goes up by 10%, your profit goes up by maybe 15 or 20%.
Because your fixed costs, your factories, your corporate headquarters, your basic R&D staff, they stay relatively flat. So every extra dollar of sales is almost pure profit.
That's the magic of scaling. Exactly.
Right.
But what we have here is the inverse of that. The evil twin. Revenue fell by 3.1%. But their operating expenses, the money they spent on R&D, on sales, on just running the company, surged by 39%.
Wait, 39%?
39%. They spent $3.6 billion on OPEX this quarter. So you can picture it, right? The top of your financial funnel is getting a little bit smaller, and the middle of the funnel, the spending, is just exploding wider.
That's not a squeeze, that's a vice grip. It's crushing the profit margin from both ends.
It's a voice grip. It annihilates the bottom line.
But why? I mean, why would you spend 39% more when your sales are going down? Is this just bad management? Is it corporate bloat? Are they just wasting money?
No. And this is the absolute crux of the bull case for the stock. This is not accidental. This isn't them buying fancier lunches or hiring thousands of useless middle managers. This is a deliberate, strategic, almost existential choice they're making.
They're buying chips.
They're not just buying chips. They are buying the future. The report explicitly details the massive investment in what they call the Cortex-2 supercluster. And they mention spending on H100 equivalents.
We hear that term, H100, thrown around a lot in the AI space. But let's give this some context. We're not talking about a few servers in the basement.
No. Oh, God, no. We are talking about tens of thousands of the most advanced, most expensive GPUs on the planet. We're talking about building data centers that are on the scale of what Meta or Google or Microsoft are building.
It's a staggering capital expenditure.
It is. Tesla is looking at this slowing car market, and they're essentially saying, you know what? We don't care about maximizing our profit this quarter. We are going to take all that cash we would have booked as profit, and we're going to dump every last cent of it into training our AI.
So they're essentially burning the furniture from the auto business to feed the computer in the AI business.
That is a fantastic image for it,
Yeah.
yes. Because they believe that Computer, the AI, the full self-driving, the robotaxi network, or the Optimus robot, is going to be worth trillions of dollars.
Yeah.
They are more than willing to sacrifice 30 cents of EPS today for the shot at total dominance tomorrow.
It's a breathtakingly high-stakes bet, though. I mean, if that AI vision doesn't pay off in the way they expect, they just torched billions and billions of dollars of shareholder capital for nothing.
It is the biggest poker hand being played in the industrial world right now. No question about it.
Okay, so that explains the profit drop. It's a choice. But there's another weird anomaly in these numbers that I want to get to. We talk about operating expenses going up, but I saw a headline about margins actually improving. How is that possible?
Yes. And this leads us perfectly into our next section. Because if you thought that profit drop was interesting, wait until you dig into the margin paradox.
Slide 2, the engine of profitability. The margin paradox. That sounds very dramatic.
It really is. It feels like a tale of two cities inside this one profit and loss statement.
Yeah.
Because on one hand, you have their gross margins, which improved significantly. And on the other hand, you have their operating margins, which, as we just discussed, are getting compressed.
Let's peel that onion apart. Gross margin first. That's the pure profit they make just on building and selling the product itself, right? Before all the big R&D and corporate spending.
Correct. It's simply your revenue minus your cost of goods sold. COGS. And here is the big surprise of the quarter for a lot of analysts. GAAP gross margin hit 20.1%.
20.1%. How does that stack up historically?
Well, it's fantastic compared to where they were just a year ago. It's up 386 basis points. A year ago, it was sitting at a much weaker 16.3%.
Wow. So that's almost a full 4 percentage point jump in their pure manufacturing profitability.
It is. And remember what we just established. Revenue is down. They're selling fewer cars. Usually when you sell fewer cars, your factories become less efficient. You lose your economies of scale. The fixed cost of running that factory gets spread over fewer units.
Right, it's just basic math. Running a factory at 80% capacity is way more expensive per car than running it at 100%.
Exactly. But somehow, Tesla defied financial gravity here. They sold fewer cars, but they made more pure profit on each and every one they sold.
How did they pull that off?
It's a combination of three main things. First, and this is probably the biggest one, is GOVGS reduction. That cost of goods sold. We are finally seeing the massive deflation in raw material prices hit their income statement.
The price of lithium.
The price of lithium has fallen off a cliff over the last 18 months. Cobalt, nickel, all the key battery components are cheaper. So the commodity cycle is finally working in their favor in a big way.
Okay, so that's number one, cheaper parts.
Number two is what we call the energy mix. And we're going to do a deep dive on the energy segment in a minute, but you have to understand this part now. Tesla Energy is growing like a weed, and its gross margins are now approaching 30%.
30%? That's higher than the car business ever was, even in its glory days.
That's the point. So as that energy division becomes a bigger and bigger slice of the total revenue pie, its higher margins pull the company's total average margin up. It's like the smart kid in the group project lifting the grade for the whole class.
Okay, that makes a lot of sense. A higher margin business grows, the total margin grows. What's the third driver?
The old classic. Regulatory credits.
Ah, the credits, the controversial free money, as some people call it.
Well, it's virtually 100% margin, right?
Sure.
The report specifically notes higher regulatory credit revenue this quarter. This is cash paid to Tesla by other automakers who failed to meet their government-mandated emission standards. It's a pure transfer payment.
And it goes straight to the gross margin line.
Straight to the bottom line of that calculation. So let's be intellectually honest here. Part of that impressive 20.1% isn't from some secret manufacturing wizardry. It's from cashing checks from their competitors.
But still, even with that, a 20% gross margin in this kind of economic environment is nothing to sneeze at.
It's very strong.
But then we get to the operating margin.
Right. And the operating margin fell to 5.7%. That's down 50 basis points from a year ago.
So just so I'm clear, gross margin went UP by almost 4%, but the operating margin actually went down. That gap between the two is enormous.
That gap is the AI spending we just talked about. That huge chasm between the 20% gross margin and the 5.7% operating margin is a canyon filled entirely with that 39% surge in R&D and SG&A expenses.
That really visualizes the strategy perfectly, doesn't it? They made all this extra money in the factory through efficiency and lower costs, and then they immediately walked it over to the lab and spent it all and then some.
That is the perfect summary. Tesla is becoming incredibly efficient at making things. That's the gross margin story. But they are spending with reckless abandon to invent the future. And that's the operating margin story.
Now, before we leave profitability, I just want to circle back one last time to that earnings per share number, that gap. We had 24 cents gap and 50 cents non-gap. That's more than double. That's a massive difference.
It is. And it's really important we have a quick, serious conversation about stock-based compensation, or SBC.
This is a real sticking point for a lot of value-oriented investors I know.
As it should be. That spread, that huge difference between the two numbers, is almost entirely made up of SBC. Tesla, like a lot of tech companies, pays its engineers, its executives, its key factory, leads very heavily in stock options and restricted stock units.
Which, if you're just looking at a cash flow statement, looks great because no actual dollars are leaving the company bank account.
Exactly. It's what they call a non-cash expense. So for the non-GAAP number, they add that expense back in. They say, look, our true cash generating power is 50 cents a share. But, and this is but SBC is a very real cost to you, the shareholder.
Because of dilution.
Because of dilution. Every single share they grant to an AI engineer is a tiny slice of the company pie that you no longer own. It increases the total number of shares outstanding, so your piece of the pie gets smaller.
So while it's not draining the corporate bank account, it is draining your personal equity in the company.
That's the trade-off. So when you see that headline beat of 50 cents, you just have to remember that a big chunk of that beat was paid for by diluting your ownership stake.
It's an important piece of context.
Now, the argument is, if that engineer builds a robot that makes the company trillions of dollars, you don't care one bit about that dilution. You're happy you made that trade. But if they don't, well, you just paid for a very expensive party and didn't get much in return.
Okay, let's move on from the high-level financials to the actual business units. Where is this $25 billion in revenue actually coming from? Slide 3, the engine room business segment performance. So we have the three main buckets here. We've got automotive, we've got energy, and then we have services and other. Let's start with the big one, the one everyone thinks about, automotive.
Or, as we're calling it on the slide, the slowing core.
Ouch. That hurts to hear. I mean, for a solid decade, the word Tesla was just completely synonymous with hypergrowth auto company.
And that's the reality of the business cycle. The automotive segment is maturing. It's no longer an explosive startup. It's facing a cyclical contraction. When we talked about total company revenue being down, that decline is almost entirely driven by the auto segment.
So the entire narrative around this part of the business has to shift.
Completely. The story is no longer auto is the primary growth engine. The story is now auto is the cash cow. It's the mature, stable, profitable business that generates the cash needed to fund the next, more speculative phase of the company.
It's paying the bills so the kids, or in this case, the robots, can go off to college and try to change the world.
That's a perfect analogy, and that's a really hard mental shift for the investor who bought the stock in 2020 expecting 50% car growth forever and ever. That era, for now at least, is over.
But then right next to it, we have the new star, energy generation and storage.
This is the real bright spot in the report. If you're a Tesla bull, if you want to feel good about the future of the company, you look at this segment. Energy grew 25% year over year.
25% growth while the core auto business is shrinking. That's a heck of a divergence.
It's a massive divergence. And remember the margins we just talked about, nearing 30%. This segment is now accretive to the whole company. It's no longer a side project. It's actually pulling the overall profitability of Tesla up.
This really feels like the validation of that long-term thesis we've heard for years, that Tesla isn't really a car company, it's an energy conglomerate that happens to sell cars.
It absolutely does. And just think about the macro picture for a second.
Yeah.
What does this AI boom that we're in require more than anything else?
Power. Massive amounts of electricity.
Massive amounts of power.
Yeah.
And a stable grid. Data centers need huge amounts of backup battery storage. The grid is becoming more and more unstable with intermittent renewables. Who sells the best-in-class, industrial-grade battery storage systems, the Megapack?
It's Tesla. They're basically the shovel seller in the AI gold rush.
In a big way, yes. They are a primary user of AI, but they are also building and selling the core infrastructure for everyone else to use AI. This quarter proves that the energy business can act as a powerful counterweight. If auto is in a slump, energy can lift the whole company. It makes the entire enterprise much more resilient.
I want to pause on the valuation implication there. Because if the energy business is a 30% margin business with long-term utility contracts, that sounds a lot more like a high-growth utility or an industrial tech company than a car maker.
That is the blink and you'll miss it takeaway. For a decade, Wall Street has valued Tesla as a car manufacturer with, 15 to 20% gross margins. By scaling this energy business with 30% margins, they are fundamentally changing the quality of their earnings.
It's not just that energy is growing, it's that the quality of Tesla's overall revenue is improving at the exact moment the quantity of auto revenue is stalling out.
That's it right there. It's a huge shift.
And just briefly, what about that third bucket, services and other?
That's just the steady compounding grower in the background. This is the supercharger network, it's the insurance business, it's repairs and maintenance.
It's the subscription model, in a way.
It's the recurring revenue base. It's
Yeah.
high margin, and it just keeps ticking up quarter after quarter. It's the boring, reliable friend you want at the party when the auto business starts getting a little too wild.
We love boring and reliable when it pays the bills. So, okay, the business mix is clearly shifting in a big way. But does Tesla have the money to keep this insane spending up? You said they're spending like crazy on AI. Can they afford it? Slide 4, financial strength and shareholder rewards.
Well, if you're a Tesla bear out there and you're hoping for a cash crunch or a bankruptcy, you're going to be waiting a very, very long time.
Why is that?
Because they have what can only be described as a fortress balance sheet. At the end of the quarter, we're looking at $44 billion in cash and liquid investments.
$44 billion. That's an immense war chest.
It is a staggering amount of money. To put that in context, that's more cash than most major legacy automakers have. But it's combined with the lack of debt that most big tech companies would envy.
So it's an industrial company with a tech company's bank account.
That's the perfect description. And what does that $44 billion buy you?
Flexibility.
It buys you resilience. We're in a tough spot for the auto industry right now, a cyclical recession. Other car makers are scrambling. Ford is cutting shifts. GM is delaying new platforms. EV startups are going bankrupt left and right.
Right.
Tesla can endure this downturn comfortably. But more importantly, it allows them to continue to outspend all of their rivals combined on the next generation of technology, on AI.
They can afford to buy the H100s when the legacy auto guys are worried about making payroll.
Precisely. While everyone else is just trying to keep the lights on, Tesla's building a whole new power plant.
But what about the cash flow? I mean, a $44 billion pile is great, but are they burning through it with all the spending?
That's the amazing part. No. Free cash flow remains positive. Even with that massive surge in OPEX, even while building these superclusters, they are still generating more cash from operations than they are spending on investments.
So they are self-funding this entire pivot.
They're self-funding it. They aren't borrowing money to do this. They're not issuing new stock. The car business, even in a slump, is still generating enough cash to pay for the future.
That's impressive financial discipline. But it brings up the question I know a lot of our listeners have. If they have $44 billion in cash sitting there, why are there no share buybacks? The stock has been volatile. Why not step in and buy back some shares to support the price and reward shareholders?
That is the buyback question. It's the elephant in the room every quarter. And the report gives a very clear answer. No share buybacks were conducted. In fact, the diluted share count actually increased slightly because of that stock-based compensation we talked about.
So management is basically giving a hard no to buybacks right now.
Management is shouting from the rooftops, "We have a better use for this cash." They're choosing liquidity and reinvestment over returning capital. They believe that buying a GPU cluster today will generate a much, much higher return on investment for shareholders in 10 years than buying back their own stock today would.
That's a very aggressive, almost arrogant stance, isn't it? It's basically telling the market, we know better than you what to do with our money.
It is the ultimate all-in signal. Think about it. If they were buying back stock, it would signal that they think the company is undervalued and, crucially, that they don't have any better ideas for what to do with the money.
Right.
By not buying back stock, they are screaming, "We have huge ideas, they are incredibly expensive, and we need every single dollar of that $44 billion to make them a reality."
So they are absolutely prioritizing those future growth vectors over any kind of short-term stock price support.
100%. And that frustrates the day traders who want to see a pop today, but for the long-term believer in the company's mission, it's a very consistent message.
Speaking of that mission, let's look at where this is all supposed to be going. Management had a lot to say about the future in this report. Slide 5. The road ahead management's outlook and key takeaways. The phrase of the day, of the year, probably? Physical AI.
Yes, they used it over and over. Management explicitly called 2025 a critical year for the company's transition from being hardware-centric to being a physical AI company.
What does that actually mean, though? Is it just a cool buzzword to get a higher valuation?
I don't think so. I mean, it means bringing the kind of intelligence we see in large language models, like the AI we all use to write emails now, and putting it into the physical world. It means cars that can actually see and reason and drive themselves. And it means humanoid robots that can understand tasks and perform them in the real world.
And as we've spent this whole time discussing, with that spending, they are putting their money where their mouth is.
It's not just marketing fluff. When you see a 39% jump in OPEX, that is the cold, hard financial proof of this pivot. They are betting the company on it.
But we still need to build things. Right, they still need cars. What's the actual product roadmap look like? Because 2025 is feeling more and more like a transitional bridge year.
It absolutely is a bridge year. 2025 is the bridge, 2026 is the destination. And the report gave us some key confirmations. Production ramps for both the Tesla Semi and the Cybercab are slated to commence in the first half of 2026.
First half of 2026. So we're in January 2026 now. That means that's imminent.
It's right around the corner.
Yeah.
First half means in the next 5 months. That's not some distant promise anymore.
And the report also mentioned they are ramping 6 new production lines this year,
Which implies a massive increase in volume potential is coming. This is why management believes this revenue slump is temporary. They expect that volume growth story to restart violently once these new products hit the market and scale.
And then there was a robotaxi update. This was just a small line item in the press release, but it felt huge to me.
The milestone they hit in Austin, Texas.
Right. It said Tesla began removing safety monitors from robotaxis in Austin, Texas in January.
That is the holy grail of autonomous driving. For a decade, full self-driving has really meant self-driving with a terrified human with their hands hovering over the wheel, ready to take over.
Right. The safety driver.
Removing that safety monitor means you're moving from supervised testing to actual real-world deployment. It's a statement of confidence. It means they trust the software enough to put a completely empty car on a public road.
That's a massive regulatory and technical step forward.
It's everything. It's the difference between a science project and a commercial product. Because if they can prove they can do it safely in Austin, then the path is clear to do it in Phoenix, then San Francisco, then every city.
Okay, so let's try and bring this all together. The final synthesis. What's the one big takeaway from this incredibly complex quarter?
The verdict is
The beat. It really wasn't about selling more Model Ys.
not at all. The beat was about financial engineering on one side, squeezing every last drop of efficiency out of the factories to boost that gross margin. And on the other side, the powerful rise of the energy business.
And the company is essentially managing its way through a trough.
A deep cyclical trough in the EV market. They're hunkering down, they're protecting that cash pile, while simultaneously funding a massive secular boom in AI and robotics.
It's an incredible balancing act.
It is. And honestly, this report, for all its messiness, shows they're walking that tightrope pretty successfully so far. They didn't fall off, they beat expectations.
Yeah.
And most importantly, they kept that AI dream fully funded for another quarter.
So what does this all mean for you, the listener, trying to make sense of this?
It means you have to ask yourself a fundamental question about what it is you think you own. Do you own a car company that's struggling with growth? Or do you own a robotic startup that's on the cusp of a breakthrough?
Which brings us perfectly to our final provocative thought for the day.
Exactly. I want you to really mull this over. Is Tesla a struggling car company with shrinking revenues and compressing operating margins? Or is it the world's largest, best-funded AI startup, which just so happens to have a $25 billion quarterly revenue stream from a side business to fund all of its research?
That's the whole question right there. Most AI startups have zero revenue and are burning cash. Tesla has $100 billion a year in revenue.
And this Q4 2025 report suggests that they're willing to sacrifice any and all short-term profits to prove to the world that they are the latter. They're betting the entire farm on it. The only question left is, are you betting with them?
A fascinating place to leave it. As always, none of this constitutes financial advice. We are just two voices breaking down the data that's publicly available. Please do your own research. This content was generated by AI.
And hey, if you enjoyed this level of detail,
Want institutional-grade stock research without the institutional price tag? Check out STOCKANALYTICS.AI.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks each, with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at STOCKANALYTICS.AI. Make smarter investment decisions with research you can trust.